So hello and a warm welcome from me here, located in Berlin, Germany. My name is Jens Klatt, and here in today's webinar, we want to have a look at the next week and what could potentially drive the FX, the equity indices, FX markets, equity indices, and also commodity markets. And yeah, today we want to have a special focus on a very interesting data set, which will be published in around 90 minutes from now, the non-farm payrolls. In fact, it's not the first time, but it's been a while since the non-farm payrolls have been interesting to watch and were capable of really moving markets. Usually, yeah, it covers the employment situation, and this usually drives speculations around the further monetary policy path from the Fed, in this case, the Federal Reserve in the US, US Central Bank. And so the thing is that this path was leveled in the past over the last months. And now there were some developments taking place over the last days with some volatility in yields here, resulting in some volatility in equity markets. And this is what we want to have also look at here to be optimally prepared for this news event. Before we start, nevertheless, we have to go through the risk disclaimer first. Please make sure that you understand that Forex and CFDs are complex instruments and that they come with a high risk of losing money rapidly due to leverage. That you please be advised to study the key information documents, the so-called KID from Admiral Markets, which you can get access to by contacting Admiral Markets directly here via the contact details we go through in a few seconds. And to study those KID, in this case, those documents here, in order to understand the nature, risk, costs, potential gains and losses of the products offered by Admiral. Then, yeah, since August, not June, but August 2018, there's a differentiation between retail clients and professional clients, the so-called ESMA decision, and something to take care of. When you choose Admiral Markets, it's not only due to a very, very competitive offering in terms of the DAX here, with a typical spread of 0.8 points during the main trading hours. In Germany here, by the way, Admiral Markets is known as the so-called DAX expert. So when people look for a broker who offers or who has a very competitive offering in terms of CFDs, and here especially around the DAX, then Admiral is one of the, if not the first choice of traders here. But it's also due to the handling of the ESMA decision, why Admiral is definitely a broker to consider. So let's come back to the ESMA decision first. So there were leverage restrictions, or there are now leverage restrictions for retail clients with a maximum of 1 to 30 for Forex majors like Euro USD, but also and also 1 to 20 for other currency pairs, so-called minors, like let's say GBP CAD, for example, but also CFDs on indices like the DAX, but also gold. But it's a different offer for professional retail clients here. So this is usually what you have to expect what you will face when you're a retail client. In case of Admiral Markets, there is the chance you can apply for a professional client status, and if you meet certain criteria which have to be met to get this professional client status for recategorization, reclassification, also contact Admiral Markets directly. There's the thing that here, this is the main profit, can we say profit, or the main advantage to be a retail client, that you have an unlimited protection against negative balances. In case of a professional client status, this is not the case, but Admiral Markets offers up to 50,000 GBP negative balance protection according to their policy. So also one good reason to contact Admiral and consider Admiral Markets to be your broker. So here are the contact details. Feel free to reach out to Admiral Markets for further details on their offering. This is me, and I'm the one who will guide you through the next 45 minutes here through the following agenda. So we want to have a look at what are the key economic events in the coming trading week. Not only that, but today with a special focus on the non-farm payrolls, which could, by the way, have a major impact on the developments then in the upcoming trading week, and you will soon see why this is the case. Then there's also the question we want to answer here: what's the current bias in the FX, equity, and commodity markets? So I already mentioned it at the beginning here. The thing is that currently the yield market is starting to present itself a little more volatile. 10-year US Treasury yields spiked above 3%, or made it above 3% already several days and weeks ago, but nevertheless they accelerated on the upside a little after the ADP employment change came in on Wednesday, significantly above expectation, and was confirmed by a very strong reading around the ISM non-manufacturing data set, also around the ISM employment component. And those two, ISM employment and ADP, are usually good indications for the non-farm payrolls, which will be published today. So the ISM situation especially came in very, very good. So we saw a record high here, record printing, with the highest reading since 1997, and the ISM employment came in at the highest level since 1998. And so the current bias is that non-farm payrolls should usually come in better than expected. But the interesting thing about this is that this is when we believe what we currently see in the markets, and it's really yield driven, and higher yields mean that currently there's some pressure forming on equity indices, that this means that positive NFP data will result in a drop in equities. The interesting thing is that the same is true for a print which comes in below expectation, something we want to have a look at. And so it could be that we currently face a so-called lose-lose situation in equity indices, especially in the DAX, and an acceleration on the downside. We've already seen some losses in the morning, could probably push us towards and below 12,000 points. It would be, yeah, in fact, a very, very bearish scenario. Nevertheless, one which is definitely something to take in mind here. And so, yeah, the question also is which trading opportunities may arise, not only thanks to the non-farm payrolls, but also then in the upcoming week of trading. And now we want to jump right into the action. And here we can already see it's dollar JPY. We have open here. And we are obviously attacking a very significant region. Nevertheless, it's very interesting price action. So if we zoom a little into the chart, you will see what I'm talking about. So the region around 114 here has seen where there was a serious attack at this level on Wednesday, thanks to the ISM non-manufacturing data set. The yield market, and therefore, one second please, I have one chart which illustrates exactly that. So I've published a book in 2014. It was on Forex trading, and within this book I also made this correlation a topic here. And I just want to, so it's no coincidence then that here you read now a German language. So it's a German book. The thing is, nevertheless, where it's German, nevertheless, it's easy to understand. So you have the yields of 10-year UST notes in this case, and USD JPY. So USD JPY in gray to black here, while orange is the yield of 10-year UST notes in this case. Here you have the yield level, so in percent, it means 3%, for example, while this is the reading of the dollar JPY. Only problem here is that you can see that the chart goes back to January 2003, yes, but it ends in July 2014. So I published the book in 2014. So the problem is that I have no further data than within this chart. Nevertheless, the correlation still is there. And what you can spot is that usually if yields rise, you should expect the same to happen in dollar JPY and the other way around. The reason for that is very simple, has to do with the low yield environment within which the JPY finds itself since the 1990s, in fact. And it's usually used as a so-called carry trade vehicle here, in this case, meaning if you want to finance a carry trade, if you're going for yield and you want to fund your trade here, you usually use a so-called cheap currency. In this case, JPY is one of the cheapest. It's not the cheapest anymore. In fact, currently the let's say #1 carry trade vehicle or funding currency is the Swiss franc, in fact. But nevertheless, JPY is close to the same level here, even though Swiss franc is slightly more attractive because it has a more negative yield here. But, and this is the thing, so usually you expect yield and dollar JPY go hand in hand. So with this in mind, the developments yesterday here, they are very, very difficult to understand, because usually you see yields pushing higher, something you can see here. By the way, this is a chart we will have a look at a little later on. Oh, I just see that I haven't prepared this, but it's quick. So let's go over to a website called Market Watch. And on Market Watch, we want to have a look here at the 10-year T-note yields. Here. So we type in 10, and then that should get the job done already. There we go. And there you can see it already, 3.2. That means 3.2%. It's only one day here. So we want to have a look at the whole development for the last 5 years in this case. So we tap on all, and then you will see that we're currently seeing yields here at the highest level since 2011. So with this in mind, and this push higher, usually you should say, or you would say, well, I expect dollar JPY to push higher too. So all in all, and if you go back to the year 2016 in June, July, you will see that this is in fact true. So if you zoom into the chart, or hey, well, it's true. It's difficult to say that. So we've seen a big rally here, a big rally after the election of Donald Trump. We remember that was the speculation around fiscal stimulus here, tax reductions, in combination, especially with the ECB and also the BOJ, still delivering lots of QE here, and so resulting in speculations around the so-called global helicopter money. In all, which pushed especially U.S. yields higher back then. Now the thing is, you can see that we are still trading significantly below the lows here of 2016, which you can find around 118.50. Nevertheless, the thing is that we are obviously higher, and this is also has to do with the fact that we are, it is yield driven in this case. So, what do you want to say? The following. It's very interesting to note that dollar JPY wasn't capable of taking on momentum over the last days, but presented itself weak as it presented itself yesterday. And that was the first sign for a potential risk off starting to develop within the market. So markets started to really fear something. But nevertheless, the problem I see with this argumentation currently presenting itself within the media, for example, saying it's rising yields, which is the reason for this development here in equities, seeing equities coming lower. I think it's very, very difficult because, and there are several reasons to that. First of all, I mean, the point these articles make is definitely true. No question about it. Therefore, have a look here at this one, the margin debt and the S&P 500. And so what you can see is that since 2008, 2009, when the Fed started with their QE program, you can see that, or you can really see a significant ramp up in margin debt here to the highest level ever measured. Okay, so we are talking about nearly 700 billions here in margin debt currently at the NYSE. alone, by the way, while the S&P follows suit here in this case. And now the thing is, if yields rise as they currently do, usually you say, okay, margin debt will be reduced rather sooner or later. It will result in a natural deleveraging taking place, similar to what we've seen in 2007, 2008 here around the financial crisis, but also around the dot-com bubble, new economy here in 99 and 1999, respectively 2000. The thing is, nevertheless, and this is something which you can spot here, from 2005 onwards, and this is something we don't want to look at right now, but what you will find out is the rate hike cycle started in 2005, 2004, 2005, when the Fed started to step-by-step hike rates by 25 basis points. And the interesting thing was that from 2006, the end of 2006 onwards, there was a huge ramp up in margin debt while yields rose back then. Okay, so if you remember that, by the way, we can also have a look at this. This makes definitely sense. So there we have the website tradingeconomics.com, and I've already prepared everything. So we can go via indicators, countries to the US here, and then we go to the interest rate. And what I'm referring to is the following. 1 second. So this is the current rate hike cycle we find ourselves in. Now, if you go back to the to max, we can go down. We can go back into the 1970s, and I'm referring here to this rate hike cycle. You can see 2007 here, so it starts in 2004, 2005, somewhere here, and you can see that this hike or this rising yield here goes hand in hand with market participants increasing their leveraged bets here, in this case on the NYSE and in the S&P. Okay, so it doesn't necessarily mean that rising yields go hand in hand with the drop in equities. In fact, you can show, and this is something I've prepared here. It's a great follow, by the way, on Twitter. It's Ryan Detrick. There's lots of statistics he delivers on a day-to-day basis here, and also something on the developments here on yields. It's only around 1 week ago or something. So it was last week when he presented this chart here. So one of the most misunderstood investment relationships is between stocks and rates. Higher rates usually mean stronger stocks. As this chart shows, since 1996, there have been 12 periods of a higher 10-year yield, and the S&P gained every single time. So I will just do the following. Probably 1 sec. It's like. That's not so cool. One second. Let me do it that way then. I want to open this in a separate tab here. Oh, doesn't work. So let me just try it again. Yeah, perfect. And now I zoom in. Boom. So what do we have here? Well, it illustrates that rising yields once again go hand in hand with a higher S&P. I mean, he's looking at it from a broader perspective, or from a taking back or going back 3 to 4 steps. Look at it from a broader perspective, not only looking at 1 day of trading here, as yesterday, for example, but looking at it from a broader perspective. And you can see here a duration of 6 months, while 10-year Treasury yields rose back then here by 150 basis points. Well, what you can see is that the S&P, for example, gained 6.7%. Same is true here, for example. Huge gain back then. That was around the new economy. That was 16 months. Yields rose by 260 basis points, 10-year Treasury yields, while the S&P gained nearly 46%. The same is true here. You can see it here. The period when treasuries started to rise back then, due to this rate hike cycle induced by the Fed from 2005 onwards. So you can see also here the S&P gained back then. So all in all periods since 1962, that was 24 instances, not all shown in this here. There was a median, the average of 30 months of such a rising yield environment. You saw a change in 10-year Treasury yields by 220 basis points, and on average, the S&P gained 6.1%. So, make long thing short, saying that rising yields go hand in hand with a drop in stocks, or a drop in the equity indices like S&P, Dow Jones, but also the DAX, for example, is definitely something to have a closer look at, and at the end you will find out it's not true. Nevertheless, the current market environment is slightly different, since this seems to be the current bias. So if you carefully watch the ticker, you will find out that it's probably the reason for the drop in equities. Currently, drop, I mean, what are we talking about? Let's have a look here at the chart, in this case, from the Dow Jones, prepared it here. What are we talking about? Well, we've made new all-time highs on Wednesday. That was mainly driven by the ISM non-manufacturing data set, was in the afternoon. And then we saw a drop now from here, 26,000 and around 950 points, back to 26,400 and rounded up to 450. So it's a drop in this case here of 500 points. And everyone is screaming, oh my God, there's a crash. It's no crash at all, and no one really realizes it, even though one has to remember that also the VIX spiked slightly yesterday. It could be the beginning of something bigger, even though nothing really happened. And as long, in the Dow Jones in this case, as long as we trade above 26,300 points, nothing really happened here. So everything is as it was before. Nevertheless, it's worth remembering that currently probably markets are looking at the yield developments, and if yields rise, it's probably one reason to see speculation growing that there could be some kind of deleveraging, which means nothing more than if the non-farm payrolls come in better than expected today, it does not necessarily mean that the equity indices will push to new all-time highs in this case, or respectively push higher, but it could mean that the market comes down from the current levels and continues the drop it initiated already yesterday. So in this case, relating to the US equity markets, but this could also mean further losses in the DAX in this case. So therefore, have a look here. We've already seen weakness from the start into the trading day. By the way, the setup based on the open range, for example, played out today once again. You have the open range here in red, for example. There was the breakout, and the risk reward of 1 to 2 here in this case was gained here within this push. And so far, we find resistance now at this exponential moving average 50 on a 5-minute time frame, which I usually use as a, even though rough, but nevertheless good trend filter and indicator. And so far, as long as we trade below this blue line, I consider the advantage in the DAX in this case to be on the short side, to be found on the short side. And it could be with a good data set around the non-farm payrolls that this drop continues if US equity markets drop on such a good data set. So now the interesting thing, nevertheless, is that it's not necessarily sad that we'll get to see a good data set here. And therefore, let's have a look, and I will close this in this case, and this too. The interesting thing is here, this is a chart from Bloomberg, and some of you probably wondered, how is it possible, where does these numbers come from? So if you check the website from Admiral Markets and here the Forex calendar, and you go via analytics and Forex calendar, you can personalize, let's call it, this economic calendar the way I did it already. And then you will see here non-farm payrolls. It's 1:30 p.m. London in this case. It's a forecast of 185,000. So some of you might have wondered, okay, where does these 185,000 come from? And they come from such guesses here, or such estimates, which you get from asked analysts here from Bloomberg in this case. So for example, two said that the reading will be between 120 to 130,000. Okay, and then you just count this, and at the end you will find, or you have the possibility to draw such a distribution here, and you get a highest point, which you currently find at 184, 185,000. And this is exactly where this number here comes from. Then, so all in all, you can see that's a quite broad spectrum here of analysts which were asked around their expectation for the non-farm payrolls. So the interesting thing now is the following. As I already pointed out, ADP came in better than expected, and it's not only ADP, but it was also the ISM non-manufacturing, which came in better than expected. And interesting enough, there were some adaptations to this expectation around non-farm payrolls today, like Morgan Stanley, for example, pushed their expectation up to, I think, 206,000. It was around 190,000 or so before. But, and this is the interesting thing about this, is it's only Morgan Stanley, let's say. So there are some doubts now, for example, based on the fact that during the month of August, during the month of September, for example, it's known that the Bureau of Labor Statistics, which publishes the non-farm payrolls here, has some trouble in terms of giving out stronger than expected numbers because of temporary and returning workers here over the summer months here. And this usually has a tendency that the numbers come in lower than expected and are then revised higher in the upcoming months. But if you look at those numbers around the ISM employment, if you look at the ADP data set, such a disappointment here in today's data set could result in an already disappointment among market participants who are betting on a better than expected a data set. And why is this relevant? Well, this has to do with the current positioning of market participants in the commitment of traders report, something we mentioned already several times over the past, and probably today is the day where there could be some kind of unwinding of this ultra aggressive yield long bet market participants currently holding. What do I mean by that? Well, 10-year T-note futures show the current here most aggressive short positioning from large speculators. This is the green line since ever measured. So market has never been more short T-note futures before, and we know about the inverse correlation between T-note futures and yields in this case, meaning that if they are aggressively short T-note futures, it means they are, on the other hand, aggressively net long yields in this case. So if now the non-farm payrolls come in lower than expected, or disappoint market participants after good readings around ISM employment, respectively the IDP data set, this means nothing more than there is potential for a bigger short squeeze than here in T-note futures, which could lead also to higher volatility in the bond market, which could easily spill over the equity markets and result in bigger volatility not only, but I think also in a more aggressive drop on the downside, pushing in this case equities lower. So there is this current bias that higher yields are bearish for stocks, but it could also be that a push lower in yields, quite aggressive one based on this current positioning of big speculators here in the commitment of traders report, that also this could cause some volatility and a drop in equities too. So it's a very, very tough spot right now for equity indices, I think. And based on that, I really look forward to the data set. So I really do not know in which direction the data will be delivered. My personal hope is somehow that they come in lower than expected, because I think this causes way more volatility than a higher than anticipated reading would bring us. Even though based on ADP and ISM non-manufacturing data set, I think numbers will come in better than expected. And so it's some kind of a coin flip, and I really look forward to it. But what I can say is that I'm already prepared in terms of what to expect here in terms of price action in the markets. So especially if numbers come in lower than expected, I'm definitely not only watching dollar JPY. I could imagine in this case, by the way, that the JPY outperforms all currencies against the US dollar based on this quite sharp push higher here on dollar JPY, and knowing the strong correlation, positive correlations of dollar JPY and US yields in this case. So if yields push lower in this scenario, dollar JPY should aggressively push lower. And I'm not only seeing a push down towards 113, but in the next days then, in the upcoming trading week, a potential push down towards 111.50, 111.80. In fact, this is the first target on the downside, even though the picture from a pure technical standpoint starts to get, let's say, cloudy only if we push below 110 again. And this is something we have definitely to wait for. But nevertheless, there is a good potential, if numbers disappoint, that there will be a push lower, while I see the overall positive, or not positive outlook, but the overall bullish potential to be limited on the upside, since most of such a good reading is, thanks to the ISM, thanks to the ADP, already priced in. So this is also something to keep in mind. Could be that the numbers come in as expected, and this is also a disappointment for market participants and results in an unwind of this yield long positioning, also potentially pushing, for example, dollar JPY lower. By the way, when talking about dollar JPY and yield sensitivity, you also have to have a look here at gold in this case. And let me just see. Does this work? No. Okay. Sometimes I have a little trouble, but here with yes. So let me just close this probably. 1 second. Does this work? No. Yes. Yes. No. Okay. Okay. So for whatever reason, it's not displayed correctly, but this is nothing to worry about right now. What we worry about is what to expect around non-farm payrolls. So look at this current situation in gold here, and this range we find ourselves in between 1,180 USD per ounce on the downside, and especially I think on the upside, 1,213, 215 USD per ounce here. So if yields push or come down and NFPs disappoint, I think there's a high chance that gold will see a bullish breakout on the upside, which could easily drive us higher, up to minimum 1,240 USD per ounce. I think even higher than that, and I wouldn't be surprised if such an unwind of the current yield long bet happens, that gold could see a push up to 1,300 USD per ounce. So I'm not talking about today, by the way. So not that you get me wrong, but I think then if we get to see such a breakout above this red line here, this one, I think this will be a very, very dynamic and aggressive breakout. And I think chances are good that there will be a strong trend developing, which could easily push us significantly higher within the day, yes, but also resulting in a strong and dynamic trend structure, which will push us higher than up to 1,300 USD per ounce. On the other hand, as long as we do not break out here on the upside, there's still also a high chance, given that there will be the breakout on the downside, even though I consider the breakout on the upside, thanks to this yield sentiment extreme, we call this, to be something to hope for a little more, since it's a potential action event then. But nevertheless, there's also a chance that we break lower if non-farm payrolls really come in better than expected. And if this break happens, that's the next target on the downside, which is activated. It's really low, so around 1,160 USD per ounce. And below that, we can also then probably see a push down towards 1,120 USD per ounce in this case. So also for gold, it's a very, very interesting situation currently, and non-farm payrolls will most likely result in at least an attack on one of those two regions here, while I currently definitely favor the upside. That has also to do with the fact that gold presents itself strong. What do I mean by that? Well, yesterday when yields pushed higher, it was the same. It's true for dollar JPY in this case. When you see gold, yields pushing higher, usually expect dollar JPY to push higher and gold pushing lower. And there was into the evening then a push back towards and slightly below 1,200 USD per ounce. But all in all, we have to say that this development here in gold shows some kind of strength, since we didn't see another push down towards 1,180 USD. So it seems to be some inherent, let's call it inherent strength currently in gold. And the moment US yields can't go forward or can't go any further with their current bullish momentum, and there will be a corrective move minimum, I think gold has a very good I'm very optimistic for gold, and I think there's a good chance that there will be an aggressive push higher in this case then. Yeah, so that's it around gold then. Let's have a look now at Euro USD, not only when it comes to the non-farm payrolls today, but also when it comes to the outlook for the upcoming trading week. So we have dropped quite sharply after the Fed, but it wasn't induced here, this push lower towards 115 and also below that level. It wasn't induced due to the Fed and their statement that was mostly priced in last week on Wednesday. No, it was mainly driven by Italy and some tensions building between Rome and Brussels here around their budget for 2019. So here is it's very interesting. So that Rome delivered a budget for 2019, a budget deficit here of 2.4% of the GDP here. The number which Brussels gives out or wants to see being accepted is 2%. So it's above above this let's call it line in the sand around new budget deficits in terms of the GDP. Well, this said, it's now very interesting to note the further developments. And to be honest, tensions started to build last week from Thursday onwards, but now over time decreased a little. And the question is why, if those tensions started to decrease, and by the way, I will present to you why these tensions start to decrease a little in a few seconds, why couldn't the euro profit from that, but kept on falling here? So the tensions decreased after there were now rumors spread. It's still not given fact that there will be such an agreement, in fact, but the politicians here in Brussels, or Brussels in general, will decide on this budget plans from Italy, I think on the 15th of October, if I'm not mistaken. And so the interesting thing about this is now that they probably find a deal agreeing on a budget deficit of 2.4% in 2019, and then step by step reducing it down to 2%. So it's 2.2% in 2020, and then 2% in 2021, and then meeting the criteria here from Brussels in this case. The bad thing about this is we are most likely about to enter a very difficult phase of the economic cycle here, and chances are growing that there will be at least a stagnation in the overall economic growth. And we know how difficult it was, and it still is, for Italy to keep the pace here in terms of economic growth. In fact, they see the slowest economic growth, if they see economic growth at all, if you can call it like that, in the European Union here, even below the numbers delivered by Greece, for example. And the interesting thing about this is now, with the ECB about to end their QE program in December this year, the thing is that we are about to enter this quite difficult phase of the economic cycle, and about to see a decrease in spending in Italy. And we know we did this before, or not we, but the European Union did this before. That was in Greece, and didn't work out well. So we are about to enter, I'm not saying a recession, but nevertheless an economic slowdown, and do not plan to overcome it by spending more, but reducing reducing the spending here. So this said, and in combination with the still quite, let's call it positive positioning from market participants in the Commitment of Traders report. Therefore, let's go over to here, the euro. 1 second, please. It takes a little. So there we go. What you can clearly spot is that market participants are still at least slightly net long the euro with nearly 4,000 contracts. So we are not talking about a huge position, but I think based on those or based on this negative outlook for the Italian economy, which will rather sooner or later hit the euro again, and we will definitely face another we will face another, I'm not saying crisis, but at least some discussions between especially Rome and and Brussels here, and other more aggressive spikes in Italian yields in this context, I think that market participants are, or especially here, those big speculators, large speculators, are probably a little too optimistic about the euro and have good potential or good reasons to build aggressive short positions, which should push euro lower, and which definitely favors, in my opinion, short engagements in the euro, which as it is then, or which will probably continue with this weakness over the last days and aim for 113 lower. So there's no real reason to be aggressively long the euro currently, to be honest. And so intraday, we should definitely watch for down structure, falling highs and falling lows, and then trying to use retracements if they happen to enter them. And try to profit from short-term downtrends instead of expecting a huge push higher. By the way, nevertheless, if the US dollar now shows some weakness, and if the US dollar will probably see now a push lower thanks to yields coming down, thanks to a disappointing non-farm payrolls report, sure, there's a good chance that then euro can at least short-term stabilize significantly above 115. Nevertheless, it's worth watching, I think, these developments here in the Euro USD, and definitely, I think, or I would consider the advantage based also on those fundamental developments in the yield sector in Italy. I definitely see the advantage on the downside in Euro USD, and I think that there's a good chance that rather sooner or later there will be a push towards those yearly lows around 113, and probably also a push below that level down to 110 then within the next weeks. So that's it around Euro USD. Let's also have a look here at pound sterling, which is in a very difficult spot in my opinion. So if you look at those comments now from myself towards the euro and the skepticism, we know, and therefore let's have a look here at the correlation matrix. Yes, so you can see on a daily chart, and going back to 200 days here, that there's a strong positive correlation of GBP USD and Euro USD here with plus 97. That means if one goes up, the other goes up, and the other way around. So with this skepticism around well, most likely goes it up. It's not said that it's set in stone, but there's a high positive correlation, at least currently. And now the thing is that if you are drawing a skeptical picture around GBP in this case, that also means, I'm sorry, you're drawing the skeptical picture around the euro, that usually drawing some kind of skeptical picture for the pound sterling too. Now the thing is that from a technical perspective, I consider the chances for another push higher and move up to 133, 33.50 here, the highs of July in this case, I think they are still given as long as we trade above 128. And now the thing is that I think there's also a good chance that a push higher here is not necessarily induced by fundamental data coming in, but also induced by a short squeeze, which you can find in the pound sterling. Therefore, let's have a look at the commitment of traders report here for pound sterling. You can see that we also have the highest short exposure here, at least by 1.5 years, so back to May 2017. And with this in mind, and if now something positive develops around the Brexit negotiations, so there you can see it here, this thin green line, I'm showing the highest net short exposure in pound sterling back to May 2017. If now any positive news around Brexit negotiations hit the wire, there's kind of a favorable deal now between UK and the EU here, probably because of an agreement taking place around the Irish border, which is currently played a little. A short squeeze could happen, which will then drive pound sterling higher and result in gains, which you probably won't see in the Euro USD. On the other hand, mainly due to those tensions, especially around due to those tensions here. around Italy. I'm sorry, I was missing this word. Yes, so with this in mind, the situation around pound sterling against the US dollar is a little difficult. My personal take is that we are more likely to push higher from here, even though it could also mean, or we could also see another push lower due to what reason? Well, we've seen or heard about the last days and weeks that the negotiations between the EU and United Kingdom are going forward very slowly, very chewy. And with this in mind, it could mean that, especially now, let's wait for the numbers from the CFTC here for the commitment of trades report. If big speculators keep on holding on their aggressive short bets in pound sterling, it could mean that they are betting on the things going worse from here before it gets better, so that there will that there will be news which show that we're not about to see a deal anytime soon, which could then push pound sterling lower, while then things completely turn around with whatever news. For example, Theresa May facing so much pressure within their own party that she now has to deliver something, which will then result in a final short squeeze here on the upside. So this in mind, the situation in pound sterling is very, very difficult currently, and I'm not really sure if I really would go aggressively long in the current region, even though I see some potential on the upside, on the other hand. So, and finally, let's also have a look here at the DAX and my current picture here. So the thing here is that I could imagine another push lower, as I already said. Let's wait for the non-farm payrolls. Currently, it definitely doesn't look that promising. It's a quite important region, around 12,100, 130 points. If we go below that level, we've tested this already over the last hour here. If we are going to this region again and we break lower from here, and currently you can see we're about to enter this level again, and there's also some pressure coming into the US equity markets. Well, this could mean that we are about to enter a very, very weak week trading next week then, with the DAX pushing significantly below 12,000 points in this case, and then going for those lows here from May respectively. I'm sorry, not from May, from February, March respectively. March, April, around 11,700 points. Still a way to go, quite long way to go to these levels. Nevertheless, it could mean if things starts to accelerate here on the downside, that we are reaching this region quite quickly. So yeah, that's it from my end. I wish you all the best. Happy trading. Watch your stops, and talk to you again next week then here in the weekly outlook for Admiral Markets. A recording will be available within a few hours from now on the YouTube channel from Admiral Markets. So make sure that you subscribe to the YouTube channel here. Most of these thoughts I presented here in combination with charts can be found on Monday here in the traders block. On the website admiralmarkets.com, go over to Analytics Traders block, and then you will see the weekly outlook here. Scrolling down a little, you can find the last one from the 1st of October. Next one will be available Monday, 8th of October. So, and that's it for mine. Happy trading. Watch your stops. Have a nice weekend. Enjoy yourself. Talk to you again then next week. I look forward to it. See you, and bye-bye.